Hello and welcome. Today we'll look at volume based on Wyckoff theory, as well as discuss how to read volume in combination with price. And additionally, we'll showcase several strategies you could apply for day trading, swing trading, and even scalping. So if you could, like, subscribe to the channel, and stick around for the full video. Volume is the ultimate leading indicator. When there is unusually high volume in any given time period, which could be 5 minutes, an hour, a day, or a week, then the price tends to continue in the same direction in the future. This principle applies to all financial markets. When prices are rising, the market will not decrease purely as a result of low volume, but will simply move sideways as it takes a breather. Conversely, any reversal from a falling market cannot occur without an increase in volume, and is sometimes also referred to as a volume climax. Volume confirms the strength of a trend or suggests its weakness, because if the market is rising and volume increasing, then this suggests that we have a strong trend supported by an increasing number of buyers. Think about it. If this was selling volume coming into the market, then prices would fall, or perhaps move into sideways congestion before falling. And this is not the case. We can therefore conclude that the volume is buying volume, and you can expect the trend to continue. Conversely, if you have a rising trend but falling volume, then this is weak. It's logic. If the buyers are still in the market, then this would be represented by rising volume. And in this example, we have falling volume. So we can assume here that the buyers are no longer interested. The trend is running out of steam and becoming exhausted. This is the first sign of a possible change in trend. The buyers have left the market and may now be replaced with sellers. In a trend, the volume will go with the trend, so expect to see the volume decrease in the pullback of a trend. This is normal volume behavior. The buyers are taking a rest before re-entering the market to buy once more. Why? Because there has been no selling climax to signal a change in trend. If we see the following in an uptrend, with an ultra-high volume bar appearing, then this is a signal that the trend is about to reverse, as volume climaxes often highlight price reversals. This is particularly true if the extreme volume is associated with no equivalent reaction in the price. According to Wyckoff's third law, if the market requires effort, meaning volume, to rise and fall, then if the market has failed to rise with significant volume, then clearly the market is resistant to any further increase, and this volume must therefore be considered to be selling volume. If it were buying volume, then the market would have risen strongly. Here we can see that the market has been rising strongly, with increasing volume, a positive sign. However, on the last bar, the volume has been ultra high, but the market decreased with a narrow spread price bar. What's happening here? In simple terms, the buyers are no longer interested at this price, and the trend reversal is imminent. If the volume bar was buying volume, then the market would have continued to rise as in the previous bar. Instead, it has failed to rise, and the price spread of the bar is narrow. So this must be selling volume coming into the market. Points where the market trades on high volume are the points of strong support and resistance, and are the first signs of a change in the trend or a breakout. Volume helps us to confirm the potential breakout from an area of price congestion. In this example, we can see that we have high volume at the bottom of each market reversal, which is suggesting buying or accumulation at these points. The support area confirms this view, so that when we finally see the breakout, we have a great signal from our volume bars that this is a genuine breakout, and therefore a low-risk trade. In this example, the high volume is at the top of each trend, so in this case, we can assume that this is selling volume, with the market creating a region of price resistance in this case. As this is selling volume, then when we see the breakout to the downside, volume once again validates this breakout, as we have seen the high volume bars on each failed attempt to move higher. Once again, we have a low-risk entry confirmed by the volume. Breakouts and market spikes can be validated or voided with the help of volume. Without volume, we are merely guessing at the future direction of the market. With volume, we have an insight into the market and whether the interest is buying or selling. However, just like price, volume in isolation tells us very little about the market's future direction. All it can signal on its own is the interest in a market or event. For this, we need to combine price and volume together to give us the most powerful analytical tool available, which will reveal the market's future direction. As Wyckoff said, all you need to know can be found in price and volume. From Wyckoff, I learned that price action alone can only tell you what is a market present technical position and where the trend is probably headed. That volume determines the trend with more accuracy and detects turning points, but together they form a complete picture. Volume is the fuel of the market. It's what drives the market, and without it, the market will simply drift. Volume exposes the truth of the market. Volume reveals conviction in a market. If the market is moving higher, but with falling or low volume, then this is simply telling us that this is not a genuine move. Equally, if the market is falling with falling volume, then once again, this is not a genuine move. I know I'm repeating myself, but this is so simple and powerful. On their own, price and volume only reveal a part of the market information. After all, price tells you a number. Volume on its own only tells you there is interest and nothing else. However, when combined, the true market intent is revealed, giving clear signals of both buying and selling interest, something that would not be revealed by either on their own. In simple terms, the more people that participate in a price move, or in our case, the more volume associated with a price move, the more that price move is validated. When there is low volume, few buyers, then our price is simply not validated. It's really that simple. Let's talk about volume and news announcements. The markets, as we know, are always full with news of every type, from the daily release of the fundamental and economic data, to the political statements from governments, to the latest releases from a central bank. All of these pieces of news are absorbed by the markets and built into the latest price action. Now, as this new information is released into the public domain, volume reveals the effect of this information on price. By watching the change in volume as this information is released, we can instantly see how the markets are reacting to the news and how quickly the latest piece of news is being absorbed by the various market participants. What this means in simple terms is that the volume substantiates the importance of the release. If the volume rises on the news and the price rises in tandem, then the market is placing significant emphasis on this piece of news. Clearly, in this case, the price is being validated by the volume surge. Conversely, if the volume fails to rise on the news, then the market and the market participants have clearly discounted this item and consider it to be unimportant or irrelevant, as they now wait for the next release to arrive. Let's look at a few more examples of how volume plays a key part in the current and the future direction of the market. First, volume high or low. As we have seen, volume is the second most valuable item of data after the price itself. A large volume confirms market activity and that market participants are involved in the move, including smart money, who bring the highest turnover of the market. When the smart money are trading, it means they are interested in price at certain levels, and they literally push the price up or down. Low volume tells us that there are a few participants in the market, and that neither buyers nor sellers have any significant interest in the price. In this scenario, no smart money will be involved, and therefore any moves from individual traders will be weak. Second, volume and trend. Volume helps us to determine the health of a trend. An uptrend is strong and healthy if volume increases as price moves with the trend, and decreases when the price goes counter-trend during correction periods or pullbacks. When prices are rising and volume is decreasing, it tells traders that the trend is unlikely to continue. Price may still attempt to rise at a slower pace, and once sellers take control, which is usually signified by an increase in volume on a down bar or candle, then prices will fall. A downtrend is strong and healthy if volume increases as price moves lower and decreases when the price begins to retrace during pullbacks upwards. When price is falling and volume is decreasing, the downtrend is unlikely to continue. The price will either continue to decrease, but at a slower pace, or start to rise. Number 3. Volume and reversals. When volume spikes at certain price levels, traders know that this was an area of high interest at that price level. If there is a great deal of interest, it means that the level is a key one. The simple observation of volume allows traders to identify important support and resistance levels, which could play a significant role in the future. Where volume spikes are extreme, in other words, larger than any historical spikes nearby, this is generally known as a volume climax. When this occurs, traders should look for clues for the future direction of the move from the price itself, and this is often followed by a particular candle or a price bar pattern. Single volume spikes can bring price to a halt temporarily, and these are often seen during fundamental and economic announcements on a daily basis. Reversals, however, happen not over a single day, but over a series of days. If higher than average volume stays in the market for several days, a huge volume spike, volume climax, will crown a point of market reversal. Number 4. Volume and breakouts. Volume can help to validate all kinds of breakouts. When the market is consolidating on low volume, a pickup in volume can signify that a breakout is due. A breakout occurring on rising volume is a valid breakout, while a breakout that attracted no interest from traders occurring on low volume is likely to be false. If you learned something new, please hit a like button since it really helps us out, and subscribe to stay up to date with our latest releases. And check out our Academy program if you want to further level up your trading. Until next time.